Hi everyone, welcome back to Accountant's Desk. Before we dive in, if you are enjoying these beginner friendly accounting videos, please subscribe to the channel. Your support really motivates me to keep making helpful content for you. In today's video, we are going to learn the most important basic accounting concepts, the principles behind why we do what we do in accounting. These concepts are essential to understand before we move on to the journal entries, ledger, or final accounts. So stay with me till the end. I will give you simple examples for each concept. Business entity concept. According to this concept, the business is treated as separate from the owner. This means that owner and the business are treated as separate. When the business owner invests capital into the business, it is treated as liability for the business. Money measurement concept. The money measurement concept says only transactions that can be measured in terms of money are recorded in the books. This means that only money or money's worth are recorded into the business. If you have a team of amazing employees, that is great, but unless you pay salaries or bonuses, it won't appear in the accounting records. Going concern concept. The going concern concept assumes that the business will continue operating in the foreseeable future. According to this concept, every decision in the company is taken with the objective in mind of running the business, not liquidating it. Let's say the business buys an asset and the life of the asset is for 3 years. So instead of depreciating the whole amount in 1 year, we depreciate for 3 years according to the life of the asset. So according to going concern concept, we assume that the business will continue operating long enough to use the asset fully. The business isn't shutting down anytime soon. Cost concept. According to cost concept, assets are recorded at their original cost, not at current market value. It means that we record the cost of the asset at the price we have purchased, not according to their current value. For example, we buy a building for rupees 10 lakh, and in future if the cost increases to 15 lakhs, even though we record the cost of the building as 10 lakh in our books because it is the cost that we have purchased the building. Dual aspect concept. The dual aspect concept says every transaction has two sides, a debit and a credit. That is, assets is equals to liabilities plus capital. This is the base of the double entry system. Every equation must stay balanced after every transaction. For example, we have purchased goods for cash rupees 10,000. Then the transaction will be purchase account debit rupees 10,000 to cash account rupees 10,000. Now we can see that debit and credit both are equal. Revenue realization concept. According to revenue realization concept, income is recorded when it is earned, not when money is received. Let's say we sold goods for rupees 10,000 in the month of March, but we have received payment in the month of April. Still, we will record the sales in the month of March because we made sales during the month of March. So, according to revenue realization, when we sell the goods, we record the income, not when we receive the cash. Matching concept. According to the matching concept, expenses must be recorded in the same period as the income they help to earn. Let's say we have electricity expenses of rupees 3,000 in the month of March for producing goods that we sell in the month of March. Both should be recorded in the same month. That is expenses of the electricity bill and then sales during the month of March should be recorded in the same period. Consistency concept. The business should use the same accounting method each year for comparison and accuracy. If you change the accounting method, you must explain the reason. According to this concept, the business must follow the same accounting principles, such as for depreciation. There are different methods in depreciation. We can't use the straight line method in 1 year and reducing balance method in next year. It does not help us to compare our accounting system. So we need to follow the same accounting principles every year. Conservatism concept. This concept says anticipate losses, not profits. The business will record future losses but won't record income until it's actually earned. Let's say the debtor may not pay us money, so we create the provision for doubtful debts. But if we have an expected profit from the deal in the next month, we will not record it now, so that the business needs to be prepared for the future. Accounting period concept. The accounting period concept means that a business's life is divided into fixed time periods, usually one financial year, to measure its performance. This means that even though the business will continue to operate, we prepare profit and loss account, balance sheet for 1 year to know the position of the business, if the business is making profit or loss. Full disclosure concept. According to the full disclosure concept, all important financial information must be clearly disclosed in the final accounts. The financial information helps stakeholders like investors, creditors, government to make the informed decisions. So, we need to disclose all the financial information. If there is a lawsuit against the business or if loan is taken, it should be disclosed in the notes even if it doesn't appear directly on the balance sheet. Materiality concept. The materiality concept says that we should record and disclose only those items that are important enough to influence business decisions. This means that the business should record all the important information that is required, but small items can be just adjusted. Materiality means we focus only on the important transactions. Small things that don't affect the business's big picture can be simplified. Example, if the business buys a calculator for rupees 500, it can be treated as an expense instead of an asset because it is not material to the financial statement. Objectivity concept. The objectivity concept means that all accounting entries should be based on verifiable evidence like invoices, bills, contracts, or receipts, not personal opinion. This means that all the accounting transactions should have an evidence like bills. It should not be just guesswork or an opinion. I hope this video helped you understand the basic concepts of accounting. If you found value, hit the like button and subscribe for more practical accounting videos every week. Also check the description for other videos on journal entries, golden rules and more. See you in the next video.